Paragraph 76B. Example 1. Mr. X purchased 5,000 shares in ABC Limited for 100,000 rands 2 years ago. In the current year, ABC Limited declares a distribution of 45,000 rands to Mr. X. The directors of ABC Limited indicate that 20,000 of this is contributed to tax capital. So 45,000 gets distributed. And they say how much? 20,000. 20,000 of that is contributed tax capital, so the remaining portion of that, guys, must be a dividend. Right, what is the taxable income for Mr. X if he holds the shares as capital or if he holds it as a share dealer? Okay, so this is a great example of paragraph 76B, the application of it, and this is probably the most important example. It's not as complicated as the one where the assets were acquired before 1 October 2001. This is the one that you must understand first. So, if we hold it as capital, what's going to happen? So the first thing I want you to understand is the dividend is always a dividend. So, dividend received, dividend exempt. What do we then do with the contributed tax capital of 20,000 rands? Now, paragraph 76B says we need to reduce our base cost if we're holding it as investment. So, our base cost when we purchased was 100,000 rands. Less our return of capital gives us a new base cost. Now guys, I want you to just see, here's my CGT column. There's nothing in this CGT column. We haven't done anything with it. Okay, we just have a new base cost. So if you later on sell the shares, this will be your base cost. What happens if he's a share dealer instead of an investor? Okay, so if he's a share dealer, first of all, we have an opening stock deduction because it was purchased 2 years ago. Then we receive our dividends, normal. That 20,000 rand receipt, it gets included in our scheme of profit making and gross income. Why? Because gross income says if you receive something in the scheme of profit making and we are a share dealer, it gets included. And we have closing stock which we add back. So please make sure that you pay attention to this, what happens to that 20,000. In situation B, it's income, and in situation A, it's a deduction against base cost. Okay, now, example 2. Same situation, guys, but paragraph 76B is a little bit more complicated because here the shares were purchased in 2000, so before 1 October 01. Mr. X purchased 5,000 shares for 100,000 rands. In the current year, 45,000 is declared, 20,000 of that is contributed tax capital. So it's exactly the same. I deliberately did it the same, guys. 20,000 rands CTC and a dividend of 25. The market value of the shares immediately before receiving this was 250, and then the market value of the shares on 1 October 2001 was 145, and time portion of base cost was 138. Now, remember, there's a whole complicated way of doing this, but your valuation date value, the most common rules is that it's the greater of market value, time portion, base cost, or the 20% rule, which is 20% times your proceeds less cost after 1 October. Now, first up, I want us to do this. Let's look at part, it says here D, sorry, it just obviously followed the same sequencing. That's just a word error. I'll fix that for you guys, A and B. Okay, let's look at situation B first, when it's part of his share portfolio. This is the easier one. Okay, I want you to see this is the same as in the previous example. Opening stock, dividend received, dividend exempt, 20,000 rands return of capital, 100,000 closing stock. Okay, share dealer. What happens though if you are a investor? Remember, paragraph 76B wants us to take our base cost less our return of capital, and that gives us a new base cost. If the shares were purchased before 1 October 2001, this is a problem for us, that base cost there. So we need to first recalculate that. How do they tell us to calculate it? They say you must calculate it as if you sell all the assets at its market value of 250,000 rands. You calculate CGT, but you don't include in the CGT column. And then you treat it as if you bought it for 250 minus the capital gain. So let me go and show you in situation A. So first up, here's the dividend, normal. Okay, now, we are treated as if we are selling the assets at 250,000 rands. Our base cost you determine in terms of your normal rules for assets before 1 October 2001. Okay, so in this case, you use the greater of market value time portion base cost, or the 20% rule. Market value is the greater, 145. Okay, quite often also they'll tell you, give you this. So the first thing we do is we are treated as if we sold the asset. So look here, we treat it as if we sold it for 250,000 minus our base cost gives us a capital gain of 105,000. I want you to see, here's my CGT column, and this line I've drawn here is very deliberate to show you that nothing is taking place here. You are then treated as if you bought it for 250,000, less that capital gain. That gives you the base cost of 145. This is our new base cost, right? But let me just make sure you see. This is our base cost here before the return of capital. Then we have a return of capital, so that is our final new base cost there, the 125,000 rands. Guys, step by step, follow it in the same process, and that is what you do there. Okay, then example 3, not as common, shows the situation where the return of capital is greater than the base cost. Mr. A holds all the shares in AP2I Limited, base cost is 5,000, and AP2I Limited gives an amount of contributed tax capital to Mr. A. What is the treatment if the contributed tax capital is 3,500 rands and Mr. A holds it for capital purposes? Capital purposes. Okay. 5,000 minus 3,500 gives us an adjusted base cost. New base cost, and make sure again, you see there's nothing in the CGT column. Okay. B, what happens if Mr. A holds it as a share dealer? Then it's gross income. Can you see the difference here? Here's a deduction against base cost. Here's just gross income. What happens if the amount was 7,000 rands and Mr. A holds it for capital purposes? 5,000 is our base cost. 7,000 needs to be deducted, but you can't have a negative base cost. So that excess is CGT. Look at that, goes into my CGT column. And then D, what happens if it was 7,000 and Mr. A is a share dealer? Then it just gets into our rands column. And that is paragraph 76B.